Good afternoon. I'm Jim Jessup, income strategist for Virtus ETFs. Today's Portfolio Insights call will focus on the current opportunity in private credit and the Virtus Sykes AAA Private Credit CLO ETF, ticker PCLO. Private credit income products are increasingly top of mind for FAs, offering the potential for higher yields and attractive risk-adjusted returns and lower correlation to publicly traded traditional bonds. Today, we'll be hearing from George Gedelius, Sykes Investment Advisors Chief Investment Officer for Leveraged Finance. George brings with him multiple decades of experience managing bank loans and high-yield bond strategies and has a long history of actively managing CLO vehicles through various market cycles. But first, I want to introduce our moderator for the call, Joe Terranova, who is the Chief Market Strategist for Virtus Investment Partners. Joe is a CNBC Ensemble member, appearing regularly on the Halftime Report and Closing Bell, and is a contributor of financial content across CNBC's media and digital platforms. Before I turn it over to Joe, I'd like to remind our audience members that we invite you to ask questions at any time throughout the webinar. To ask a question, please type into the Q&A section at the bottom of the screen. And with that, Joe, could you give us a brief capital markets outlook and then stage the conversation about private credit?
Jim, thank you for that wonderful introduction. Good afternoon for all of you who have taken time out of your busy schedule to join us. I'm excited for this call. This call is a call in which I believe we will all be educated. We'll be educated about the ability to further diversify portfolios with asset classes that might be somewhat unfamiliar to us, but certainly asset classes that we should give consideration towards. And with that, when we think about the environment, Jim, in 2025, it is the environment in which you're giving consideration to unfamiliar asset classes, if you would. The reasoning and really the evidence that supports that premise is if you maintain two distinctively different perspectives on 2025, one in which says, look, in the near term, we've got elevated volatility as markets are trying to digest an unexpected sequencing of fiscal policy, right? The expected sequencing of fiscal policy was that regulatory relief, the extension of the tax cuts from 2017, that would further lift markets and extend the bullish optimism that was prevailing and certainly the bullish trend that was in place coming into 2025. Markets were a little bit caught off guard, though, because the initial implementation of fiscal policy was, okay, let's address fair global trade. While addressing fair global trade does not have that immediate bullish sentiment surrounding it. It's uncomfortable, and it's been difficult for markets to digest that. However, though, when you maintain this longer-term perspective and you say to yourself, well, does any of the near-term volatility or the unexpected implementation of fiscal policy defeat the conditions that we have in place for a bull market? And the answer to that and the evidence to that suggests no. In fact, there's not. You have very strong profitability. You have earnings growth. You have a disinflationary trend that's even stronger outside of the United States than it is here, in particular in Europe. And you have a Federal Reserve that, look, similar to President Trump's administration, believes the next policy, the policy move should be to continue to move policy out of restrictive territory. It's just they have a different time frame, if you would. So I think that affords you the opportunity to kind of stay anchored, use time, use patience to navigate the volatility. And we're clearly, since the Geneva weekend 3 weeks ago, we've recalibrated the expectation, in particular for China, on what the tariff rate is from 145% back down to where consensus was at the beginning of the year. We're seeing a rebuilding in terms of positioning and sentiment that's actually lifting markets closer to all-time highs. But I think what the most compelling aspect of all of this, and this is why the conversation with George is really important today, is if I'm a portfolio manager, if I'm a steward of capital over the last 2 years, it's a tough environment because you have this narrow concentrated performance and narrow concentrated earnings growth from, call it 7 to 10 stocks. It's the overwhelming majority of the gains. It's isolated to those 10 stocks, 2023, 2024. That's uncomfortable because we're never going to really allocate a portfolio in that concentrated a direction. And that creates an environment where you're basically chasing beta. And that's what the last 2 years have been about. Here we are, 2025, and we've now restored the concept of diversifying once again. The concept of diversifying once again by asset class, geography, by equity size class, and by strategy. And the reason for that is you've got dispersion. You have dispersion in earnings. So it's not just technology and communication services where you're seeing the growth. You're seeing the earnings growth in unfamiliar places in mid and large cap industrials and financial companies. You have economically tailwinds that have presented themselves for the very first time outside of the US, like in Europe with the disinflationary trend, like in Japan with critical reform. And then you've got this challenge to global governmental balance sheets because of excessive issuance and rising deficits. And really, what's that doing is it's creating an opportunity in taxable fixed income because you're seeing, as a consequence of that, a little bit of spread widening. But corporate balance sheets are really in good condition, as are consumer balance sheets. So you've got this opportunity now to generate alpha and to restore the premise of diversification. And I think that's why in 2025, it really is in an exciting time in the midst of an elevated volatility period within the larger context of what is a bull market for the capital markets and risk assets overall. So, George, I want to invite you into this conversation at this point. It's great to see you. I know you're very excited about this conversation. And for everyone on the call, George and I share an affection for the New York Islanders and that hockey team. We've had some really good news surrounding that. So George and I offline will share our excitement for that. But George, if you can, just kind of educate all of us, familiarize myself, the audience, with private credit markets. You're accessing private credit through CLOs. Just talk a little bit, describe, define what are CLOs and the potential investment benefits they offer.
Sure, Joe, and thanks for having me on. So, yeah, we access private credit really through collateralized loan obligations or CLOs, as you said, Joe. They're securitized products. They're backed by a pool of below investment grade corporate loans and securitization. For those unfamiliar with it, it's the process of combining a large number of loan issues into a single pool. So you may have seen it with mortgages, with credit cards, auto loans, very similar, and other types of debt, commercial properties. So in the case of CLOs, the pools are just basically backed by loan of corporate borrowers, many of which you would be very familiar with. So this vehicle, the CLO, issues debt. So the assets, if you will, if you'll think about it as a balance sheet, the assets are the loans, which pay a coupon, and the CLO issues debt, which are the liabilities. And these debt tranches have various credit ratings, depending on how much cushion there is, how much collateral, essentially, and priority claims on the cash flow of the CLO. So lower rated tranches have lower priority for repayment, and then the inverse is true for higher priority. So AAA would be paid out first, single B, double B would be paid out last. So the further you go down from AAA down to single B, it becomes more equity-like, and again, the inverse as you move up. So we strongly believe that the safest way to access private credit is through AAA-rated tranches of a CLO ETF.
And the different types of loans that the CLO can hold would be?
Yeah, so there's basically two different types. So there's broadly syndicated, otherwise known as BSL, the initials. Widely syndicated, could be to 100, 200, 300 investors that would be investing in that particular loan, and middle market loans. So middle market is typically smaller companies under 100 million EBITDA, although there are exceptions now. The middle market has grown, and that's why the name has kind of changed from middle market over to private credit or private lending. So as the name implies, broadly syndicated, goes to many investors, and they're underwritten by the large investment banks that you're familiar with. Private lending is more direct. So these loans are negotiated between the borrower and a handful or even one lender, without the middleman, without involving a bank for origination or distribution. So that lack of intermediaries or middlemen, if you will, could benefit investors by providing somewhat higher yields. The other difference is just the reinvestment period. So the shorter the reinvestment period, the shorter the life of the CLO, the sooner that investors are repaid. And so private credit CLOs have shorter reinvestment periods than the BSL market. And that shorter duration can, of course, make them less susceptible to market movements. And then, just as far as loss rates that, people, I think might have some misconceptions on how much subordination and structural support, comes with CLOs. So I would say private credit investors overall enjoy very low historical loss rates, better structural protection, better covenant protection than the BSL market, and sponsors are typically more supportive as well. So at the top of the debt stack, the AAA rated tranche, again, you're first in line to receive payments, so they've got the lowest risk in the CLO structure, and that's why they get the AAA rating, and they are essentially over collateralized by 30 to 40%. And if you look at yields, AAA CLOs yields are kind of nestled between traditional high yield bonds and investment grade corporates, with significant yield advantage over traditional core bonds.
So hopefully I'm understanding it correctly. There's a different risk profile between the two. Could you give us an example, almost a quasi stress test of kind of how each has performed in a most recent volatile period?
Yeah, at the AAA level, to be clear, Joe, the difference is from BSL and private credit AAA tranches, it's minimal. Both have never experienced losses, including 2008, 09. So there is, and you would need even probably worse than a 1929 scenario for these tranches to be impaired. So there are minimal differences, but overall, the risk profile of both is very similar.
Okay. And we just have a follow-up question. Someone's asking again, BSL means what? If I've got it correctly, it's broadly syndicated loans.
Right.
Okay. Thank you.
So again, so a typical buyer of that could be a mutual fund, leverage loan mutual fund, a leverage loan ETF, traditional crossover high yield buyers, and then of course the CLO market, which is about 70% of the market. So the order book, if you will, could be hundreds of investors.
Okay.
As the name implies, broadly syndicated.
Yes.
Private credit, again, kind of as that name implies, private, it's a handful. Sometimes you could have just one investor. It's highly negotiated, very bespoke. Many more covenants on the private credit side relative to BSL.
Mm-hmm.
So there are some inherent advantages on the underlying.
Okay. So let's kind of turn the conversation, if we could, towards the execution, the strategy. And by the way, as I asked George that question, I want to remind everyone, we want to hear from you. We want some questions for George. But George, talk through a little bit the key characteristics and features of PCLO, and strategically how you're navigating.
Right. Yeah. So our approach is we're buying AAA tranches, but on top of that, we want to buy the highest quality private credit CLOs from managers with good track records, long histories, and a deep team. There have been a lot of, as everyone knows, there have been a lot of kind of recent entrants into the market, and they might have teams on the East Coast or the West Coast. That's not where a lot of private credit companies are located. They're typically in the Midwest, kind of the heart of the country. So we want, we want managers that have the teams that exist where the companies are. So PCLO looks to invest in higher quality private credit CLOs that we believe have higher yield potential than kind of traditional fixed income investments. And again, kind of in between investment grade corporates and high yield bonds. It provides a lot of diversification for investors with that potential for higher income and lower volatility. And we saw that, in the first 4 months of this year, how different the vol was in AAA CLOs versus other fixed income asset classes. And finally, there's very low correlation to core bonds. So, overall, we would say that it provides exposure to the highest quality and most liquid portion of the private credit, CLO market at a relatively low cost. So it's a very efficient way to access private credit. It's built for scale, and it has, we think, the potential to play a significant role in kind of the alternatives playbook for investors as the lines between public and private markets continue to intersect.
Can history teach us anything about our risk assumption? And can we even use history as that guide?
I think you can. I think the best period to obviously look at least in our lifetimes, is 08. And everyone kind of remembers the subprime debacle. And that sometimes gets spread, that experience gets spread across other structured products. But to be clear, AAA CLOs were unimpaired, period, during that time. So it never a default, no interest deferred. 2020, same thing. So I think the asset class has really demonstrated that it's battle tested, and it has that extra subordination, that cushion that investors are looking for. And if anything, actually, if you think about it, the subprime debacle put more protections in across all structured products. So, CLO investors, debt investors, actually benefited because rules became more stringent, and as a result, AAAs became even safer.
Yeah. So one of the audience attendees references 2008, and as you said, AAA CLO did not default during that period, but the valuation and market to market obviously went down. Could you give us an understanding of by how much, and very similar in 2020?
Yeah, I would say on average, marks probably down, depending, again, you had to look at the underlying portfolio that each CLO manager had, but marks on AAAs probably down 5 to maybe a dozen points on average. So that's a big move for the AAA market. But compared to what was going on in equities and even just the underlying loan market and high yield market, it was a very relatively brief period too. Things snapped back very quickly. The highest quality always does. So yes, there is mark-to-market volatility, and that's a good time to mention that all investments, including this one, have risks, right? This is not. I've heard some terms that I'd probably rather not repeat on this call on that. That this is cash equivalent and that sort of thing. It's not. It's an investment that has underlying credit risk. but there is a very, very thick layer of cushion at the AAA level.
And fundamentally, the low correlation to bonds.
Mm-hmm.
What if you could, how would you describe those fundamentals that allow for that low correlation?
Yeah, it's a combination of being floating rate, right? So, the biggest the risk over the last 2-3 years is as duration has worked in most periods. It's worked against investors, and we've seen negative returns on not just investment grade but treasuries for time certain time periods. So you have floating rate, you have underlying floating rate interest rates tied to SOFR.
Hmm.
And you've got, because of the lack of defaults, the lack of interest deferral, the
Hmm.
battle-tested nature of the asset class, your standard deviations are very low. You have good Sharpe ratios. So it's almost counterintuitive, but if you add AAA CLOs to, let's say, a traditional core bond portfolio, your risk goes down and your yields go up because of the better standard deviation and Sharpe ratios. So there's a slight yield pickup, right? So you pick up the extra yield and you're actually de-risking your portfolio.
Jim, I want to invite you in for a moment here and give us a little bit of an understanding. You're out there talking to advisors on a regular basis. Just what are those conversations like, uh, in particular for private CLOs?
Yeah, the first thing about the conversations that's surprising is the number of them. Private credit, whatever the topic of the meeting, when I'm in the field, it comes up in nearly every meeting, which is understandable. It's not often a new asset class kind of makes its way into the zeitgeist, and there's so much press around all the different parts of private credit. That was one of the motivating factors for us to work with Sykes to develop this product and kind of put it out into the world. And further, as we kind of did that, we thought we wanted to use kind of the healthiest, most durable part of the marketplace, which is AAA, which is George very fairly, or one of our viewers very fairly alluded to. You don't need a default to lose money or to have volatility in a fixed income position. And that AAA portion, with kind of the strong underwriting and kind of everything else that goes involved with it, hopefully will insulate not just from your potential drawdowns on a default, but also from a standpoint of there's so much coverage by comparison of some of the other parts of the tranche that hopefully we would see kind of less volatility around that. And also, it's an opportunity to diversify away from core bonds. It's an opportunity to have something other than the parts that we've kind of traditionally used in the 60/40. As we go into the next couple market cycles, seems to be consensus. We're going to need to take on a little bit more volatility. We're going to have to be a little bit more creative, whether that's alternatives, whether that's other parts of fixed income, to kind of all collectively achieve our goals and get the performance that we kind of need out of portfolios. I do also want to reiterate one point that George made, because it's an important one. With the income sitting between investment grade and high yield, that's a great indicator if you think of income as a measurement of risk. This is not a cash replacement. This is an investment portfolio. We would not want to hold this out as a cash-like product. We'd want to hold this out as a diversifier, as a place to own something that you don't already own before, pick up some true carry over investment grade and certainly cash, depending on the market environment. And the last point I'll make on that as well is the sourcing. I've heard from the advisory community, I may use this as part of what I have in some of my ultra shorts. Because if I do that, I'm not introducing more duration risk. I'm still sitting duration on PCLO is going to sit right around 0.08, just like bank loans, because they're callable. They're going to be very kind of low in the duration portion of the risk profile. And lastly, I'd say the CLO market, and in particular the private credit CLO market, it feels in some ways like bank loans did 10 or 15 years ago. Maybe not widely held by the retail investment community. People are starting to introduce it into their books, starting to be a little more open to being creative and carrying some other asset classes. And I think flows and market demand have kind of held that out. And that's why we think that this can be an important strategic allocation in portfolios.
Thank you for that, Jim. George, turning back to you for a moment. Can you discuss a little bit how the performance has been in 2025 when we've had this mercurial environment and elevated volatility?
Yeah, it's been slow and steady. I guess I would describe it as relatively very very little price vol, and really just flipping your coupon, and sometimes making a little bit of principal. So we have a 30-day SEC yield of about 5.7%. That's as of the end of April, and up about 2% year to date. So it has performed as you would expect. No real surprises.
And again, in the context of elevated volatility, just share your thoughts on the overall leveraged finance market.
Yeah, as you correctly alluded to before, fundamentals are pretty strong across the space. There are, of course, not every company is going to report great earnings, but overall Q1 earnings were very solid. Also remember, as it relates to tariffs, 75% roughly of LevFin revenues are domestically sourced. You don't have the big multinationals in our space because almost by definition, those are investment grade companies. So it's the local hospital company, the local cable company. So these are local companies that don't have a lot of tariff exposure. You have some in sectors like retail, which is only about 2% of the index, or chemicals. So that's where you've got to tread a little carefully. But overall, fundamentals are good. The technicals are also very good. There's been a decent amount of new issuance, but there have been a lot of kind of M&A on the sides, and we've seen net issuance barely go up this year. So there's issuance, but there are pay downs that are also happening. Just over the last 3-4 weeks, about a half a dozen names of ours have been acquired. So fundamentals and technicals are very, very strong right now.
George, I have a question here that says, do you have a 1031 option?
You'll have to educate me on that.
Well, I asked you the question because I needed to be educated on it, and I apologize. I don't get that either. I think we're coming up here on the bottom of the hour. I had said that you were going to educate all of us, George, and you did a masterful job as always in doing so. I appreciate that. It was good to have a conversation with you surrounding private credit and CLO. Jim, I know you've got some remarks here as we head to the bottom of the hour. I'm going to turn the call over to you.
Yeah, and first on the 1031, this is an ETF that holds CLOs. So the tax treatment, I'm refer to your tax professional, but it's going to be treated as an ETF. So I'm going to give you a phone number to reach out to Virtus.com. If you want to go further on that, we're happy to do so. But in closing, thank you for attending today's webinar. For additional resources, portfolio insights, please visit our website, Virtus.com. If you have any additional questions or further information, as I promised, there is a phone number. Reach us at 800-243-4361. Joe and George, thank you very much for your time.